So when we started on this journey for BUS 305, we started with the first thing of making sure that we had investment goals. What was our goals for our financial security? Then we decided we needed to look to make sure that our financial affairs were in order, making sure that we had an emergency fund that was always equal to at least 3 months of our living expenses. So now it's time for you to start thinking about saving money and establishing an investment program. The one thing that you want to remember is that you need to start early. And it's not all about getting money per se, but it's about knowing that you have invested wisely, that you have set up funds to take care of yourself for retirement and for your family. So in this chapter, we're going to be discussing the investing basics and then evaluating some bonds. I have several videos embedded in this chapter because I am not an investment guru. I can only tell you what I read, different things like that. So the first video we're going to watch is from Warren Buffett, and he's got several books out there, several other videos about investment and things that you need to look at. And then there will be some other videos that will give you different perspectives on investing. How you invest will be your personal strategy, but sometimes it helps to hear how other people have invested in what their outtakes are.
If you take a look at this 40-year run on the dollar is designed economically to lose money every single year. So why would you save something that loses money every year? And what this means for somebody on retirement plans is that after you retire, the value of your dollar goes down and your cost of living keeps going up. To my rich dad, that was bad advice and made no sense.
We sold it from 160 to 200 or something like that.
A nice tidy profit.
Yeah, we made about $3.5 billion on a $500 million investment, as it turned out. I still sold it way too soon. Since I sold it, they must have shot a gun off and said, Warren sold, now it's time to let it go up.
Well, yeah, you left money on the table.
A lot of money.
Dummy.
That's
what
exactly right.
Charlie Munger would say, right?
Charlie would say, you've done it again.
But you can't keep always trying. For the average person who's maybe never bought a stock before, what's your advice about that? You can't constantly sit there and wait and say, oh, it's going to go higher, it's going to go higher.
We don't even think about that. What we think about is how much is it selling for, how much do we think it's worth. When we bought it at $35 billion effectively, I felt the company was probably worth at least $100 billion.
How did it come to your attention? How do you find a stock like PetroChina?
I sit there in my office and I read an annual report, which fortunately was in English, and it described a very good company. And told about the oil reserves, told about the refining, told about the chemicals, everything else. And I sat there and read it, and I thought to myself, this company is worth about $100 billion. Now, I didn't look at the price first. I look at the business first and try and figure out what it's worth, because if I look at the price first, I'll get influenced by that. So I look at the company first. I try to value it, and then I look at the price, and if the price is way less than what I've just valued it at, I'm going to buy it.
And how do you value it?
Well, that's the trick. Yeah. But it's essentially what I would pay for the whole business if I could buy it. And when we sold the stock, it was valued, we'll say, at probably 250 to 275 billion. And we thought that was a fair price. Now, oil had gone up from $30 a barrel to $75 a barrel. Now it's up even further. But today, yesterday anyway, I believe PetroChina is the second most highly valued company in the world. Higher than GE, next to Exxon.
ExxonMobil.
Next to Exxon.
Have you sold the entire stake?
Yeah, I have. Mm-hmm. I wish I hadn't, but I have.
As of when?
Well, we sold it over a period of time.
Sold it over a period of time.
If it went down a lot, we'd buy it back.
Would you ever buy or sell a stock based on political pressure or
no.
sort of?
So no, the answer is no.
People being upset about Darfur had nothing to do with why you sold the stock.
The Chinese government owns 88% of PetroChina. They also own control of 29 out of the 30 largest companies in China. The Chinese government is the one that has a position in relation to the Sudan. And they have it, if you own any one of the 30 largest companies in publicly traded companies in China, you will have the Chinese government as your majority partner. And the question is, are you responsible for their actions?
You're going to China next week for a ribbon-cutting ceremony for ISCAR.
Sort of the limit of my abilities, Liz. I mean, that's what they use this.
You're pretty good at cutting a ribbon.
I've gotten used to it. Yeah.
Are you looking at other companies in China?
I don't look based. No, the answer is pretty much no. But I don't look based on countries or that sort of thing. I just read every report I can, and I try and figure out whether something is cheap.
But how would you find a report like PetroChina 4 years ago? This was not a name that maybe that a lot of people would.
Other guys read Playboy. Yeah, I read annual reports.
All right, we've never even talked about the supply picture, but he's talking about eventually being able to increase the supply of gold. You had a shareholder who asked you a question about gold over the weekend, and your response was pretty interesting. Berkshire versus gold. You want to talk about how that's performed over the years?
Yeah, but we can go beyond that. But certainly, when we took over Berkshire, Berkshire was selling at $15 a share, and gold was selling at $20 an ounce. And gold is now $1,600, and Berkshire's $120,000. But you can take a broader example than that. If you buy an ounce of gold today and you hold it 100 years, you can go to it every day, and you can coo to it, and you can caress it, and you can fondle it, and 100 years from now, you'll have 1 ounce of gold, and it won't have done anything for you in between. If you buy 100 acres of farmland, it will produce for you every year. You can use that money to buy more farmland. You can do it all kinds of things. For 100 years, it'll produce things for you, and you still have 100 acres of farmland at the end of the 100 years. You could buy the Dow Jones Industrial Average for 66 at the start of 1900. Gold was then $20. At the end, it was 11,400, but you'd all gotten dividends for 100 years. So a productive asset of any kind, a decent productive asset, is going to kill a non-productive asset over time. Now, in any given 1 year period, 5 year period, any asset can outperform another asset. Tulips.
Why don't you join me, Warren? Why don't you join me and buy some cows? I mean, I like your farmland, but you're in Nebraska for Iowa. You love steak. I mean, we can have leather. We can have manure. We can have milk. We can have meat. We'll employ people.
You can have the manure. I'll take the meat.
I've got plenty of the manure. No, but we'll employ people taking care of the cows. I mean, that little bar of gold that's worth 50, whatever. We had one in here. Look, I think it was worth like $60,000 or $70,000. I can get like so many head of cattle for that and be productive. That was my point. But you like farmland. You just too lazy to take care of the cattle or something? Pay some people.
Absolutely. Absolutely. Have you ever tried to take care of cattle, Joe?
It must be. I think it might be hard. I know I've tipped a few, but I've never.
Have you tipped? No, I've never done it. I hope you have not tipped. That's mean.
It's cruel. It is cruel. They're sweet. They're sweet, but they're not too bright. Like me.
With land, you can get somebody else to do all the work, give them a percentage of the crop, and you can sit back there for 100 years and get a percentage of the crop, and you still got the land when you get all through. I will guarantee you that farmland over 100 years is going to be gold, and so are equities.
Listening to you talk, though, Warren, when you say, with your comments about bonds, that makes me think of financial assets in general, which includes stocks. And I think about the printing presses, not only in this country, but around the world. You've seen the commercial cha-chung, cha-chung, cha-chung with the central banks. And there are periods where financial assets are great, from the early 80s to 2000. And I just wonder if there's then periods where hard assets are great. And you see Paulson in gold and some of these other guys in gold or commodities. Are you just not comfortable with commodities? Are there times where you should be downplaying maybe stocks or businesses and going totally full bore into commodities, but you're just not comfortable doing that?
No, the alternative with me, Joe, the alternative, I don't like fixed dollar investments at all. I don't like short-term bonds. I don't like long-term bonds. We own a lot of short-term bonds, but that is not because we like them. That's just a parking place. But the alternative, in my view, I mean, certainly commodities can be an alternative, but the alternative is income-producing assets of one sort or another that are not fixed dollar type investments. And so I've said consistently for the last few years, I would vastly prefer to own common stocks than fixed dollar investments over a 5 or 10 year period. I don't know about the next 5 hours or 5 days. And that might very well extend to rental real estate. It might extend to farms. I mean, an investment you're looking for something where you put out money now, and that asset that you buy gives you back more money over time. Now, the problem with commodities is that you're betting on what somebody else will pay for them in 6 months. The commodity itself isn't going to do anything for you. So there's two types of assets to buy. One is where the asset itself delivers a return to you, such as rental property, stocks, a farm. And then there's assets that you buy where you hope somebody else pays you more later on, but the asset itself doesn't produce anything. And those are two different games. I regard the second game as speculation. Now, there's nothing immoral or illegal or fattening about speculation, but it is an entirely different game to buy a lump of something and hope that somebody else pays you more for that lump 2 years from now than it is to buy something that you expect to produce income for you over time. I bought a farm 30 years ago, not far from here. I've never had a quote on it since. What I do is I look at what it produces every year, and it produces a very satisfactory amount relative to what I paid for it. If they closed the stock market for 10 years and we owned Coca-Cola and Wells Fargo and some other businesses, it wouldn't bother me because I'm looking at what the business produces. If I buy a McDonald's stand, I don't get a quote on it every day. I look at how my business is every day. So those are the kind of assets I like to own. Something that actually is going to deliver and hopefully deliver to meet my expectations over time. A piece of art, may go from $1,000 to $50 million, but it's dependent on what the next guy wants to pay me. The art itself, the painting itself, is not going to dispense cash. So I have to find somebody that's going to like it more. And with an asset like gold, for example, basically gold is a way of going long on fear, and it's been a pretty good way of going long on fear from time to time. But you really have to hope people become more afraid in a year or 2 years than they are now. And if they become more afraid, you make money. If they become less afraid, you lose money. But the gold itself doesn't produce anything.
Well, speaking of gold, though, we're looking at gold prices, and they were at another record high. They're up another $3 today, $1,434 an ounce. And there have been some big hedge fund managers, like a Paulson or a David Einhorn, who have really buckled down on these bets. Why would you steer clear, and do you think what they're doing is the wrong thing?
Well, I just don't know. I don't know whether cotton's going to go up. I mean, we use a lot of cotton, and I've watched it go from 80 cents to $1.90. We use a lot of copper, and I watched it go from $2 to $4 plus. So, I mean, there's all kinds of things in this world that are going to go up and down in price. And maybe hamburgers will tomorrow. But I don't know how to judge that. I do know how to judge, to some extent, the earning power of some businesses. And the real test of whether you would like it as an investment is whether you would be happy if it never got quoted again, and just in terms of what the asset did for you. But that doesn't. I will say this about gold. If you took all of the gold in the world, it would roughly make a cube 67 feet on a side. So if you took all the gold in the world, we could have a cube that went down there 67 feet, 67 feet high, and that would be the whole thing. Now, for that same cube of gold, it would be worth, at today's market prices, about $7 trillion. That's probably about a third of the value of all the stocks in the United States. So you could have a choice of owning a third of all the stocks in the United States, or you could have a choice of owning that little block of gold, which can't do anything but kind of shine there and make you feel like Midas or Croesus or something of the sort. Now, for $7 trillion, there are roughly 1 billion acres of farmland in the United States. They're valued at about $2.5 trillion. It's about half the continental United States is farmland. You could have all of the farmland in the United States. You could have about 7 Exxon Mobils, and you could have $1 trillion of walking around money. And if you offered me the choice of looking at some 67-foot cube of gold and looking at it all day, maybe touching it, fondling it occasionally, and then saying, do something for me, and it says, I don't do anything, I just stand here and look pretty. And the alternative to that was to have all the farmland in the country, everything, cotton, corn, soybeans, 7 Exxon Mobils, just think of that, add $1 trillion of walking around money. You know, maybe call me crazy, but I'll take the farmland of the ExxonMobils.
All right, that makes some sense. Carl, you've got a question too?
I'm still trying to get the image of Warren fondling a giant block of gold out of my mind.
Just fondling it occasionally was what stuck with me.
Bring me a giant block of gold and you'll see me fondle like you've never seen before.
So let's start by establishing some investment goals. When we're talking about financial goals, we know that they should be specific and they should be measurable. We used the SMART analogy in several chapters ago. You can also use this when you're thinking about establishing investment goals. Also, they need to be tailored to your financial needs. You'll need to answer a number of questions that would help you establish whether or not financially you're able to invest. And then you know that you always want to aim your goals at what you want to accomplish. They must be oriented toward the future. Generally, when we're talking about investing, it is long term. It's not something you want to do for a year. You're looking at 10, 15, 20 years down the road. These are some questions that you should ask yourself before you begin investment. How much money do I need? How much risk am I willing to take? What is the possible economic or personal conditions that can alter my investment goals? What about economic circumstances? And are you willing to make the sacrifices necessary to ensure those goals? Now, first, before you begin to think about investment, you need to do a financial checkup. You must make sure that your personal affairs are in order. First, are you paying your bills on time? Are you having to pay late fees because you can't pay your bills on time? Are you working to balance your budget? And remember, balancing your budget is living below your means, that you have that emergency fund. Are you managing your credit card debt? Do you pay it in full each month? You don't use credit for small purchases. You don't get cash options. How many credit cards do you have? And do you get help if you're in trouble? Have you started an emergency fund that you can quickly access and you have at least 3 months of living expenses? Do you have access to other sources of cash in case of an emergency? These could include a pre-approved line of credit or even being able to have a cash advance on your credit card. So where are you going to get money to start an investment program? Most financial experts recommend that you pay yourself first, and I highly agree with this. Each paycheck, you need to set aside a certain amount for yourself. Then you can take that money and you can either save it or invest it if you have enough to make an investment. If not, accumulate it until you do have enough to start your investment. Then you want to take advantage of employer-sponsored retirement programs. Major corporations will match part of the contributions you make. So that is something you definitely want to get into. Participate in an elective savings. That means if you have it taken out of your paycheck each pay period and directly deposited into a savings or an investment account. If you do not get it, you cannot spend it. So that's an excellent way. Make a special savings effort 1 or 2 months each year. Cut back on the basics. You know, maybe that doesn't mean you go to a Starbucks for coffee for a full month. And you take that money and you put it aside for investment. And then if you get money for gifts or inheritance, don't go out and blow it and think, wow, my grandmother left me $10,000. I'm going to buy me a new car. Take that money, invest it. Your new car will go away, but your retirement is looming. Many people will never start an investment program because they say, I only have a small amount of money. But you have to remember that even small amounts of money will grow over a long period of time. If you look at page 12, and we talked about this in chapter 1, it's the time value of money exhibit. Make sure you look at that and see how quickly your money will grow. So always remember that the higher rate of return, though, the greater the risk is involved. If someone tells you that if you invest your money in their company, they're going to give you 25% rate of return, run. Be very, very wary, because nobody's paying 25% at this period of time. So let's talk about some factors that would affect your choice of investment, and they include safety and risk. And they're two sides of the same coin. Now, risk is the uncertainty about the outcome of your investment. Investment safety means there's minimal risk of loss. Remember that investments can range from very safe to very risky, so you have to know what you're looking at. One thing that we want to look at is that from your standpoint as an investor, one basic rule that you will want to consider is the relationship between the safety and the risk. The potential return on any investment should be directly related to the risk the investor or you will assume. So you want to make sure that you know, how much risk am I taking if I buy this high risky stock. Speculative investments are generally very high risk, and they're made by those seeking a large profit in a short time. This type of investing is not for the faint of heart. It can cause people to get very, very depressed when their returns are not what they thought it should be. Also, you need to think about some of the components of the risk factors. Inflation risk. During periods of high inflation, your investment return may not keep pace with the inflation rate. Interest rate risk is the value of bonds or preferred stocks may increase or decrease with the changing interest rate. Business failure risk affects stocks and corporate bond. And then market risk is the risk of being in the market versus in a risk-free. So you will need to look at these four components and decide if you feel that you can handle these components.
Hello, welcome to Course 2, Unit 1, Lesson 1, What is Financial Risk? In this lesson, we have 3 lesson objectives. The first lesson objective is risk versus reward. The second lesson objective is what is the baseline value for risk and reward? And the third lesson objective is what causes financial risk in a business? So let's get started. So I'm sure everyone has heard before risk versus reward. And so I have this little picture here to kind of demonstrate and something to kind of think about as you take on a more risky investment. On the left, we have a marginal amount of risk and reward on the bar as the person's walking the tightrope. And over on the right-hand side, you can see that the person has taken on more risk for more reward. And what the result is that person has more pressure and more stress. And you can see how his tightrope is arching and bending there. And if he makes one little mistake as he's walking, it's going to be a total collapse of his investment. So kind of keep that in mind as you assess your risk versus reward. And so we know that our risk whenever we're investing in stocks and bonds is that you could lose a little bit or all of your money. And the reward is that you could make money and not really have to work for it very hard. So when we look at our tolerance of risk, over on the left-hand side, our number 1, which would be our lowest amount of risk for the reward, is going to be our 10-year federal note. What that is a bond, but it's a 10-year bond. And whenever you have something that short in term, it's actually called a note. So if you were talking 30 years, then that'd be called a bond. And then on the right, we kind of have a funny picture with the Ponzi scheme incorporated as our 10. So as you look at this chart, what you're going to have to do is you're going to have to assess and think about the amount of risk that you're willing to assume for each and every investment. And you're always going to compare it back to that 10-year federal note. Now, the reason that we use the 10-year federal note is because the federal government can simply print more money in order to meet that obligation. And if you were going to take just simple cash, and let's just say you held $100 in cash for a 10-year period, that federal note is always going to outperform just the cash because you're going to be making a 2.2% yield as of 1 May on that federal note, where the cash you'd be making absolutely nothing. So regardless of how inflation moves in the future, you're still going to be doing better with that federal note. And that's why we're going to use that as our benchmark to compare it to any other investment and the risk that's associated with any other investment. So what causes financial risk in an investment? We have three risks that we're going to be talking about. The first risk that we're going to talk about is debt. When you start talking about stocks and bonds, it doesn't matter either one of those investments, but if the company or the local government has a lot of debt, that is an enormous risk to you as the owner of that company or as the person supplying the loan to that company. So when we look at why a company incurs debt, the reason that a company takes on debt is because they want to speed up time. That's all it is. It's an instrument of speeding up time. If you think about it in this terms, if a person's going to go out and buy a $300,000 house and they're going to take out a loan in order to buy it, the reason that they're taking out that loan and incurring debt is because they want to speed up time. They don't want to wait 15 to 20 years in order to save up enough money to buy that home. Instead, they're going to take out the debt and they're going to go ahead and speed up time so they can move into that house right now. So when you talk about a business, it's exactly the same thing. A company incurs a lot of debt or takes on debt because they want to speed up time. They want to have that machine in order to make that product today, and they don't want to have to wait 5 years in order to save up enough money to buy it. So you might be thinking, well, why is that bad? So I might have a little bit of a lame example here, but I'm going to use it anyway to kind of maybe symbolically represent what's happening here. Let's assume that we're playing a video game. You have 30 seconds to shoot a little rat that's running across the screen. So on the far left, we're going to start off at a normal speed. And let's say that in 30 seconds, 10 rats run across the screen. And since the rats are moving at a normal speed and you're good at the game, you can kill all 10 rats. As we speed up the speed of the rat, but we still have 30 seconds to shoot as many as we can, we actually had 14 targets that ran across the screen, and we were able to shoot 12 of them, which was a little bit better than the normal speed. And then as we speed up the time, we have 18 rats in 30 seconds, and now we only killed 10 because the rat's running faster and it's harder to shoot. And then we go to a ludicrous speed, and we have 22 rats that run across in 30 seconds, but we were only able to kill 6 because the rats were moving so fast and it was really hard to shoot them. So in this example, in this silly example, we have the rat, and the speed is representing the amount of debt that the company's taking on. So as that company's taking on more debt, the company's actually becoming less productive in the long run. And as you can see, with a little bit of debt and a manageable amount of debt, which would be the rat just gradually running a little faster, the company actually performed a little bit better. And so that's something that you need to think about. If a company has debt, that's fine. If a company has a lot of debt, that's not fine because that's putting a lot of risk on you as an investor, and it always ends bad whenever you're investing in companies that incur a lot of debt. So you could maybe use this silly little example to remember that as you look at your companies and you see a company that's incurring a lot of debt, that's the company you want to stay away from. They're becoming less productive instead of just sticking to that normal speed and maybe just going a little bit faster with a little bit of debt. So here's Warren Buffett's opinion on debt, and he uses this kind of silly quote as an example. Only when the tide goes out do you discover who's been swimming naked. And what he means by this is the people who are out there swimming naked are the people who have a lot of debt. And when the tide goes out, which means that the market collapses, that's when you truly figure out who's been swimming naked, because those are the people that don't make it. Those are the companies that fail. So let's talk about our second risk. The second risk that you have as an investor is overpaying for an investment. So Warren Buffett's opinion on this is that price is what you pay, but value is what you get. So let me give you an example. So let's assume that this man here goes and sees this beautiful home. It's immaculate. And he sees that the house is on the market for $200,000. But he likes this house so much, it's just absolutely gorgeous. It's his dream home, that he's willing to pay $50,000 over the listing price for the house. So 1 year later, after this man paid $250,000 for this house, he has to sell the house because he's going to be moving for a new job. So he's trying to sell the house, and he can't get anywhere near the price that he paid 1 year earlier. And that obviously comes as no surprise. So what we have to look at is that the house was still a great house. Nothing changed about this house. He still maintained it. He took great care of it. Something else that didn't change was the market condition. So when we look at this, the poor investment was based off the initial price paid and not the quality of the home. The home was immaculate and it was great, but the investor paid way too much for the house, and that's why it was a poor investment. So when we look at how this investor overpaid for this house, and he paid $250,000 for something that was worth $200,000, how is that any different than a person in the stock market buying a stock for $25 when it's only worth $20? And what I'll tell you is there's absolutely no difference. That ratio, $200,000 to $250,000, is exactly the same as paying $25 for something that's worth $20. And that's what Warren Buffett means, and that's our second risk. Price is what you pay, but value is what you get. Okay, and the third risk associated with owning an investment is that risk comes from not knowing what you're doing. It's that simple. So when you looked at that last example, why do people value the ownership of a house but not value the ownership of a company? And what it comes down to is, on the left, people understand that. They understand the value of the home. But when you look at the right, they don't understand the value of a company. And they definitely don't understand the value of the company when you break it down into individual shares that are broken up into 10 million pieces. And so that is the true risk here. And if you're the type of person that may be out there buying companies and buying shares, and you never look at what they're worth, and you're just buying them based off of, oh, I like this company, you're probably setting yourself up for buying the $250,000 house, even though it's worth $200,000. And this is what Warren Buffett really means. Risk comes from not knowing what you're doing. So let's recap our three risks. The first one is excessive debt. You want to stay away from those companies. A little debt's okay, but a lot of debt is always going to get you in trouble. Overpaying for an investment. You've got to know what the value of the investment is before you buy it, or else you're going to be the person out there buying the $250,000 home. And the third one is not knowing what you're doing. So just a quick recap. In the follow-on lessons, in the follow-on units as we continue forward, we're always going to be comparing the value of our stocks and our bonds back to the 10-year federal note. So it might not make sense right now, but as we continue on to the follow-on lessons, it'll all start becoming clear to you. So that completes Course 2, Unit 1, Lesson 1, What is Financial Risk? We learned about risk versus reward. We learned what is the baseline value for risk and reward. And we learned what causes financial risk in a business. And I hope you guys enjoyed the lesson, and I'll see you in the next unit.
Sometimes you'll want to purchase certain stocks because they will be considered a predictable source of income. Generally, they're going to give you dividends or interest. If income is your primary objective, then you're going to choose savings accounts, CDs, municipal bonds, government bonds, or some common stocks. Some of these are some of the other choices that you can get. Also, you might want to invest in the real estate market. To investors, growth means that your investment is going to increase in value or appreciation. Keep in mind that common stocks usually offer the greatest potential for growth, and again, mutual funds and real estate offer growth potential also. Investment liquidity consists of two dimensions, and it's your ability to buy or sell an investment quickly without substantially affecting that investment's value. So at this point, you're probably asking yourself, how do I know what right investment's going to be right for me? Keep in mind some questions that you should consider. Since 1926, stocks have returned an average of about 10% a year. During that same period, government securities only earned 5%. So you're looking at a 5% difference between stocks and bonds. But before you make a decision to purchase stocks, consider these asset allocations and diversification things. Asset allocation is the process of spreading your assets among several different types of investments. And here's some of them that you can consider: stocks, bonds, risk-free assets, real estate, and then also foreign stocks. This slide just gives you some evaluation factors if you're considering common, preferred, bonds, mutual funds, and real estate. Now, when you are considering asset allocation and diversification, keep in mind that diversification is where you're investing in several different investments, and this reduces the risk because a loss in one area is going to be usually offset by gains from the other type. But here's some factors that you need to consider. First of all, your age. Growth versus income. What type of recovery time do you have if your investments take a nosedive? What are your objectives? How much can you save and invest each year? What is your dollar value if you have current investments now? What's the economic outlook for the economy? What is the tolerance for risk? This to me is very, very important, because if you are staying up at night worrying about your investments, then you don't need to be in the stock market. Your investment horizon. When will you need the money? Most of you are young. You're not going to need your money until you get ready for retirement. So you've got a long period of time to let your money grow. So that's a benefit to you to start investing now. And then this is just a website where you can go and do an asset allocation calculator. This is a good example of an investment pyramid, and it starts with what you're looking at to invest in. Level 1 is just for financial security. Level 2 is safety and income. Level 3 is growth, and level 4 is speculation. Depending again on what age you are when you start investing in the market. For instance, my husband and I we're at level 1 and 2 because of our ages. We're not going to take our retirement accounts and invest in level 3 and level 4 because they're considered high risk. But since most of you are students or getting ready to graduate, this is some area that you would want to look at. The level 3, where it's growth, you're going to because you don't need your money right now. So make sure you know what level you are at, which one you want to begin with when you start to invest. As an investor, you need to take ownership of your investment process. It will help you if you monitor your investments and you want to make sure that you're keeping accurate records. If you're going to do your own investing, make sure you have your own chart you can use, or a computer software, anything like that you can keep track of what you're investing, how you're investing, and how your investments are doing. Some other factors that you might want to consider would be getting help from a personal financial planner. Sometimes you might want to use a stockbroker, an accountant, a personal finance planner, anything like that. That's had some training in securities, insurance, taxes. One of the most things you want to make sure that you're looking at is the tax consequences of selling your investments. Sometimes it looks like, wow, I made a lot of money, I'm going to sell it. But when you look at what you have to pay in taxes, or if you take the money out, sometimes that windfall isn't as big as you would think it would be. This is just some things you should do if you're in the middle of an economic crisis. Again, we've talked about the emergency fund. Always have extra in your emergency fund. Make sure you know what you owe. You need to know what debts you have to pay. The most important thing you can do in any kind of financial crisis is to reduce your spending. If you are struggling financially, you don't go out to eat for lunch. You take your lunch. You don't go out to eat on the weekend. They're just ways that you can save money. Make sure you notify your credit card company, anybody you owe money to, and make arrangements to make payments, even if they're smaller payments. Make sure you're monitoring your investment in retirement accounts. And then sometimes you may need to convert investments into cash to preserve what value they have. Some conservative investment options that we're going to talk about to begin with is government bonds. Sometimes as an investor, you might want to consider a government or a corporate bond as a safer investment compared to stocks, mutual funds, or some other type of investors. You can also purchase bonds as a way to use asset allocation to diversify your investment. Now remember, asset allocation is to make sure that you take your assets and you put them in different areas so that all your eggs are not in one basket. Government bonds are a written pledge to repay a specified sum of money, the face value of your bond, at maturity, along with periodic interest payments. So what this is saying is that the government is going to, it's guaranteed to repay you a specified sum of money, say $10,000, 10 years, and then along the way you're going to get periodic interest paid. They are sold to fund national and debt and ongoing cost of the government. And there are 3 levels of government issues: federal, state, and local. The next little video just gives you an explanation of some bonds.
Hi folks, David Waring here again with LearnBonds.com, and today we're going to give an intro into Treasury securities, the different types of Treasuries, and 5 ways that Treasuries are different from other types of bonds. Treasuries are issued and backed by the federal government, which makes them among the safest investments in the world. Treasuries are considered by most to be free of default risk, so they are the benchmark to which all other types of bonds are measured. While there are many different types of Treasuries, they all fall into 4 distinct categories. Also known as T-bills, Treasury bills are U.S. government debt that matures in 1 year or less. Because they are backed by the U.S. government and the shortest issue, T-bills are considered by many to be the world's least risky investment. Also known as T-notes, Treasury notes are U.S. government debt that matures in 1 to 10 years. Also known as T-bonds, Treasury bonds are U.S. government debt that matures in 10 to 30 years. Also known as TIPS, Treasury inflation-protected securities are U.S. government bonds which are designed as a protector against inflation. While the coupon interest rate you receive on TIPS stays constant, the amount you get back at maturity adjusts up and down with inflation. Here are 5 ways that Treasuries differ from the majority of other bonds. Treasuries are backed by the full faith and credit of the U.S. government. Treasuries are not callable. This means that unlike many corporate and municipal bonds, the government cannot pay the bonds off before their stated maturity date. Federal income taxes apply, but state and local income taxes don't. Treasuries can be held in your name rather than the name of the brokerage firm, like most other securities. This offers additional protection to those clients holding more than the SIPC insurance limit of $500,000 at one brokerage firm. Treasuries can be bought and sold in increments of $100. Most other bonds trade in increments of $1,000. Treasury Direct, as well as many online brokers, also allow you to trade Treasuries without paying a commission. That's our lesson for today. I've included links with more information on the topics mentioned in this lesson below the video. For more great bond news and education, be sure to visit us at LearnBonds.com, follow us on Twitter at LearnBonds, and like us on Facebook at Facebook.com/LearnBonds page. Thanks for watching.
As the previous video talked about, there are different types of Treasury bills, notes, and bonds. I'm not going to go over and explain each one of these in depth. You can read more about these in your books on page 365, 366, and 367, and know the difference in them. The first two are treasury bills. One's considered T-bills, treasury notes. Here we have treasury bonds, and we have treasury inflation protected securities known as TIPS. Should you choose to, you can also invest in state and local security bonds, municipal bonds, and they're issued by cities, counties, school districts, or special taxing districts. And again, it's used to funds to use for ongoing costs for major construction. And for some information on municipal bonds, general obligation bonds, they're backed by full faith, credit, and taxing authority of whoever's issued them. Revenue bonds are repaid from the money generated by the project the funds finance, such as a toll bridge. An example of a revenue bond was Georgia 400 toll. That was a revenue bond. This is just some characteristics of municipal bonds. The interest may be exempt from federal taxes, but capital gains may not. So you need to make sure of the taxing on these, but also remember that you can buy insured municipal bonds, which private insurance to reduce the risk if that bothers you. Another conservative investment option that we're going to talk about in the next 3 or 4 slides is corporate bonds, and it's very similar to government bonds. It's a written pledge to repay a specified amount of money with interest. It's an interest-only loan. It's considered safer than stocks. It's considered a fixed income security, and it's a form of debt financing. The face value is what is considered the dollar amount that you will receive at maturity. It's usually in $1,000 increments. The coupon rate is how much interest rate they're going to pay you, and generally interest payments are made every 6 months. And then the maturity date is the date on which the value will be repaid, and it can go from 1 to 30 years. There's no exact date that they have to pay you, say 5 years, 10 years. It's whatever is agreed upon. The bond indenture is the legal document that describes the bond. A trustee is usually a bank or another financial institution that acts as the bondholder's representative. The next slide has a video on it that explains in detail about corporate bonds. So be sure you watch this one. It'd be very informative for you. These are just some examples of why corporations sell bonds. This just talks two types of corporate bonds, debenture or mortgage bonds, convertible bond, high yield bond. These are ones you want to be real careful about. The high yield, they have a higher rate of return, but they have a higher risk of default, and they're always identified as junk bonds. Some of the provisions for repayment, there's always a call feature on a bond, which a corporation can call in or buy back outstanding bonds before the maturity date. And most corporation bonds are callable, other than they're protected for the first 5 to 10 years after issue. You say, well, why would they do that? If the organization has a bond that the coupon rate, which remember is the interest rate, maybe they're paying 8% interest, but the market has nosedived, and right now most everything is paying 3%. Well, they don't want to be paying that additional 5% on bonds that still have 20 years to maturity. So they will call in, and what they do is they buy back your bonds. How they do that is they have a sinking fund where they're going to deposit money annually, and then the trustees can go and get the money and retire the bond issued that's been issued to maturity. Serial bonds are bonds of a single issue that mature on different dates. So why would an investor purchase corporate bonds? If it's interest income, this is a fixed income that they're going to get every 6 months. So the interest and the principal are paid back to the registered owner of a registered bond. A registered coupon bond is registered for the principal only, and the coupon has to be presented to obtain payment. This slide talks about the dollar appreciation of bond values. Now remember, your bond value may change with the market interest rate in the economy. Changes in the overall interest rate will cause that corporate bond with a fixed rate to go up in value. But if on the other hand, if the overall interest rate rise, then a corporate bond with a fixed interest rate will go down. So it would fluctuate on the bond value of your bonds. Bond repayment at maturity is face value repaid on maturity date, and bondholders can keep it till it matures or sell. So make sure you know what you're getting into there. One thing you can do if you're considering buying corporate bonds is you can look at their bond rating measure default risk, and you can look at Moody's or Standard & Poor's, and it gives them a rating, and it basically tells you what kind of a rating they've received, and then you'll know what kind of default risk that you're looking at for the bonds you're considering purchasing. The last 2 slides are just talking about some bond yield calculations, how you can determine what your rate of return is going to be, rate on investment that you've learned about in accounting classes. Also gives you some web information that you can go look at. The last slide is just showing you an example of Home Depot, how they purchased it, what was the coupon interest, when it would mature, and how much their rate was. So this concludes the chapter on investing basics and evaluating bonds.